Welcome to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, we're doing a mailbag episode. And actually, we're devoting the whole episode to a really good question from one longtime listener about how to interpret financial statements and jargon. And the question goes something like this. I got an email saying, for a long time, I've been trying to read these industry reports I get at work and understand how well my company is doing or how well other companies in the industry are doing based on their financial disclosures, and I can't make heads or tails of them, and I don't know how to interpret these stinking things. Could you provide some guidance on cutting through the jargon and interpreting these disclosures and statements as they're issued? And I thought that would be a very interesting topic for a podcast episode. And in today's episode, we walk through the framework for financial disclosures, why management does what they do on a quarterly and annual basis, why Wall Street stock analysts are involved, and for those of us with skin in the game related to a certain company, how should we be interpreting these things? And that could be either as an employee of a company, as an investor in a company, as the owner of a company, or maybe someone who's evaluating whether to partner or even purchase a company. There are some really general concepts that I wanted to cover today that I think will help everybody with regard to their interpretation of these financial statements and basic jargon. I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Alrighty, today on the podcast, we're going to answer a mailbag question that came in that I thought was particularly interesting. And for those of you out there who are listening and you have random financial questions that you think would make halfway interesting fodder for the podcast, feel free to email them in because we collect these things, and every once in a while we'll devote an episode to one or more mailbag questions that come in. Today's mailbag question is more of, I would say, maybe a higher level question, more like a macro question. And it has to do with the interpretation of financial statements and financial jargon in general. I should mention that the email address is info@threeoakswealth, spelled out, .com for mailbag questions. So feel free to toss stuff over there if you do have topic ideas you'd like us to cover in future episodes. That being said, this particular listener basically wrote an email that said, "Hey, I work in the outdoors industry. And every once in a while, we get these industry reports from our company leadership or from other industry publications about how well the company is doing. But I don't know what any of it means. How the heck do I interpret these stupid things?" And the question was, would you be interested in producing a podcast episode on financial jargon in general and how I should think about these things as I read through them, because a lot of it is just challenging to interpret and a little bit outside of my day-to-day job. And I thought that was a great idea because we talk a lot about investing. We talk a lot about macro investing, meaning the economic environment and interest rates and foreign exchange policy and these big level, geopolitical things going on. And we talk a little bit about micro investing from the sense of investing in equities and bonds and other types of securities on a company-to-company basis. But we've never really dived into the interpretation of a financial statement. And this could be applied to your own job if you read reports that the company publishes and you're trying to figure out what they mean and whether the company's doing all right or not. Or from the perspective of an investor, if you're interested in buying, the stock or bond of a specific company, and you're trying to interpret the disclosures for your own investment purposes. So to set the stage, it may make the most sense today to just to start in generalities and framework, and then kind of zero into this specific circumstance. Now, I read through the specific report that this listener sent over a little bit and determined that going through and coming up with an opinion on this specific circumstance might not be all that helpful to everybody. Nevertheless, I'll reference it somewhat throughout the episode, and we'll link to it in the show notes if you want to read it and follow along and kind of buffer your understanding of what the heck it is I'm talking about. So, generalities first. When you have a publicly traded corporation, the business is publicly traded because the leadership at some point made the decision that it wanted to grow really big. And when you want to get bigger, you often need to come up with money and capital to do that. It's very, 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 very hard to grow a company to a very large size and bootstrap it the entire way. Usually you have to go borrow money from a bank along the way to finance your operations, or you have to sell equity in the company to other investors, be it through the public or private markets, just to get more cash in to finance your operations. And that's sometimes a scary thing to do, to go borrow money or dilute your equity ownership, sell some shares of stock to accelerate growth. But it's often what's needed to take the next step on whatever your path is. And so if you're publicly traded, the deal is you have sold some of your equity to the public markets. Most businesses that go public employ the help of an investment bank to get all the disclosures right, to make sure that it's done legally. They have connections to attorneys who can help them do this, and then to actually take the shares of the company and sell them on the open market. And at that point, somebody else in the investing world owns some of those shares, and they're publicly traded in the secondary market. So the reason that I'm starting here is that once you decide to go public and sell some of your shares through this mechanism in the open markets over the exchanges, and your shares are listed on NASDAQ and the New York Stock Exchange and other exchanges, you have opted in to a substantially higher level of disclosure requirements on a year-to-year and quarter-to-quarter basis. So every single year, when you're publicly traded like this, the leadership has to produce what's called a 10K report. It's accessible online. Any publicly traded corporation's 10K is accessible online. It's basically the leadership, the CEO and the CFO mostly, reporting on the business's performance over the last 12 months. In addition to that, they have other disclosure requirements. If insiders, meaning directors, want to sell or buy or exercise shares, any substantial transactions or other non-stock related transactions that investors might be interested in, there are disclosure requirements where you have to publish this stuff through a specified channel, and then it's all available to investors online if they want to look into it. So the 10K is the big one. That's the annual release of the management's interpretation and explanation of performance over the last 12 months. It's also where they announce earnings per share and cash flow and dividends and all of these things. There is a quarterly requirement for that too, called a 10Q. And the 10Q is, as you probably know, these publicly traded corporations have to communicate their earnings and their performance on a quarterly basis. And for the bigger companies, generally what they'll do is announce them, and then they'll hold an earnings call after the stock market has closed and invite a bunch of Wall Street stock analysts to it and just be open and available for questions. And the reason is that everybody's incentivized here for the stock to do well. Okay, if you're the CEO or the CFO who are responsible for reporting these things, a large portion of your compensation is stock-based. So you want the price to go higher, right? So why do we have these earnings calls? The companies are not required to do the earnings calls. They're required to report through I think it's a press release or upload it to the system or whatever, how the corporation did over the last 3 months. But on top of that, they'll often invite all these analysts to an open Q&A session to pick the brains of the leadership. Because guess what? This is a marketing game. If they can convince the analysts that what they're doing is good and that the future outlook is positive, then the analysts are going to go write their reports. Other investors are going to go read the reports, and it's more likely to push the stock price higher, which is good for the executives who are handling all this stuff, right? So there is a legal framework for what you need to do and what disclosures and announcements you're required to make on a quarterly, annual basis. And there's a fair amount of, latitude in between the lines of what's legal on those disclosures and what's not. Now, if you have leadership issue one of these reports and they fudge the numbers, that's clearly illegal. These reports are not just numbers. There is also a written narrative from the CEO and the CFO and maybe from others involved too about how the last quarter or the last year went, what the specific initiatives and challenges and opportunities and strengths and weaknesses. And they're not just tables and charts of the numbers. There is a lot of text and narrative in between those charts to give investors a better picture of what's going on. Because remember, they're trying to drum up interest for the stock. Honestly, I'm not sure how much text is actually required in these disclosures, but I do know that if I'm an analyst evaluating the future outlook of a stock, that leadership in a publicly traded corporation is going to be trying to impress me so that we can drum up more interest and push up the price. So it's in their best interest to include a good story on these disclosures. Now, how they tell that story, there's a little bit of latitude, but they can't fudge the numbers, obviously, and they can't be misleading. If they're misleading, then the directors could be under legal liability, and the investor base as a whole could have legal recourse against them if they decided to organize and said, hey, we bought this thing because your disclosure said that things were good, but you lied about that, and now we're going to sue you. There are all sorts of legal structures and checks and balances in place for that to happen. So that's the framework in the public markets. In the private markets, if you work for a company that's not publicly traded, or if you own equity in a company that's not publicly traded, the disclosure requirements are totally different. A lot of them have no disclosure requirements at all. Private placements are a pretty good example of that, where you might be wondering how the company is doing if you make like an angel investment. Here's a good example. I am recording this podcast right now on a platform called Zencastr. Zencastr has been great. They record audio and video files. When I get done recording today's episode, I'm going to download the files and upload them to a shared drive where our editor takes them from there and produces all the final stuff and publishes it, right? We pay a monthly amount, I think it's $20 a month, to use this Zencastr virtual production studio. Well, Zencastr has all these cool ideas and they want to grow. So they opened up a round of investment to basically crowdfund some of these initiatives. And I said, hey, I like this platform. I believe in what they're doing. I'm not going to invest very much of my portfolio in this thing, but sure, I'll give them a small amount of cash. They've been pretty good about since, and I think I invested maybe a couple $100. This was maybe a year and a half ago. They have absolutely no requirement to tell me what's going on. I'm not expecting to get that $200 back. But, and if it happens, that'd be cool. But I was interested in the process of making a crowd-funded investment, and I was interested in promoting this specific platform. Now, coincidentally, the leadership has been pretty good about keeping us appraised of what's going on, and we get a message about it once a quarter about progress toward their initiatives and what's coming down the pipe and all these things. Because guess what? It's in their best interest to do that. If they run through this funding round and want to raise more money for the next thing because everything's going well, then they might want to solicit me and all the other investors again. And so it's in their best interest to communicate progress well. Now, if they outright lie, then, maybe I have some legal recourse. I would not pursue it unless there's a class action that I don't have to do any work for, because remember, it's only a couple $100 we're talking about. But that's how all this stuff works. So if you're in the seat of an executive, now let's switch back to publicly traded corporation. Let's say you're the CEO of, I don't know, Chevron. I'm pulling that out of thin air. A lot of your compensation, I don't know what the CEO of Chevron is making, let's call it $20 million a year. A good portion of that $20 million is going to be in cash. A good portion of it is going to be in stock options and other stock compensation. And it's not going to vest immediately. So there are a lot of situations in the corporate world where a CEO might be in a position where half their compensation is in the form of stock options or restricted shares that vest on a specific date a couple years down the road. And depending on the circumstances, it's going to be in that executive's best interest to make sure that the stock hits a high when, not coincidentally, their shares are about to vest. So the whole deal with this reporting is that executives are telling a story. They have a legal requirement to tell a story. They have legal bounds that they can operate within. But there's naturally going to be a little bit of gamesmanship here to influence the stock price in a way that aligns with their personal situation. And we are fortunate in the US here to have a strong legal system and governance structure that aligns you as the shareholder with the your interest as the shareholder with the executives. Because from your perspective, if you're a long-term shareholder, you want the CEO to be incentivized in the same way. You want them to want the share price to go up too. And even if it's a situation where they're trying to get the share price 3 years from now to be at its high, and they don't really care what happens between today and 3 years from now, that might be a little bit misaligned with your personal interest as a stockholder. You might need the equity. You might need to sell the shares in the next couple of years to go buy a house or a new car or something like that. That there might be a little bit of a misalignment there. But big picture, there are legal requirements in place. There is some latitude that executives have when telling the story, but remember, it's just a story. And they're going to influence things in a way that align with their best interests, whatever those may be. Now, let's move down the scale to what are we actually talking about? What are in these reports? And so the report that I'm looking at right now, it's for Vista Outdoor second quarter fiscal year 2024 financial results. So there are a bunch of paragraphs here and bullet points about the consolidated results from this specific company over this time period. Now, a lot of it might have to do with the macro environment. Interest rates are a little higher now. That means that our borrowing costs are a little bit higher, and because of that, our sales, while our sales are strong, our profits have suffered because our interest expenses are a little bit higher. These are the areas where they tell that story and explain what's going on. So at this point, I think it would probably be most helpful to walk through an income statement and a balance sheet, which are the two primary financial statements that you might review as an employee or as an investor or as somebody who's halfway interested in this stuff. The income statement is the most important. That's the financial performance of a company over a specific period of time. So here we're looking at the second quarter of 2020. I said 2024. This must be fiscal year 2024. So that means that their fiscal year is not January through December. It's some other time frame, and that's staggered a little bit. That aside, with the income statement, you always start with sales at the top. If you sell ice cream cones and you sell $100 million worth of ice cream cones, you write $100 million into the sales line at the top of the income statement. Then you have direct expenses or gross expenses against those ice cream cones. So let's say that you make and you sell ice cream cones, but then your operating costs to make the ice cream cones include the flour and the sugar and all the inputs to that. Those are costs of goods sold. That's what you take away. That's your first line item of expenses. So you have your sales, you take away cost of goods sold, and then you have gross profit underneath that. Another good example here is, let's say that you, what's a good example? Let's say that you sell computers. You sell desktop computers, and your business model is that you go find really cheap parts like hard drives and jacks and cases and all that online, and you buy a bunch of those parts, and then you assemble the computers and you sell the computers for more than the cost of the parts. Well, if you sell 100 million bucks in computers, and then the cost of the parts is what you include for cost of goods sold. Those are your inputs to make those computers. Difference between those, that's your gross profit. What you do underneath that is operating expenses. Operating expenses include your rent, if you need to rent space, payroll, utilities, any other ordinary operating expenses that come up in the course of doing business. So sales, cost of goods sold gives you gross profit. Then you take operating expenses. After that, you have earnings before interest, taxes, depreciation, and amortization. Sorry if this is boring for some people. I find this stuff fascinating. What you'll often find in financial disclosures and reports are changes in margins. And based on this Vista Outdoor report that I'm looking at now, it says that sales decreased to 13% to 677 million, driven by lower shipments. So they were having a hard time in their supply chain, and they were having a hard time getting goods in to sell. So that meant that their sales suffered. Organic sales were down as well. And then they talk about gross profit. Margins are something that you're always going to see reported in these financial statements. And if it costs you $100 to buy the parts for your computer, and then you turn around and you sell the finished computer for $200, your gross margin is 50%. The costs of the input costs comprise 50% of what you're selling the product for. That would be a really great gross margin. But what you want to track over time with any business is what their margins look like. And if you're getting squeezed by suppliers, and the cost of those, say the suppliers know that your gross margins are 50%, they say, hey, that's way too much. We got to jack up our prices because Jeff's business is getting too much of those margins. We should be getting more of those margins in this whole supply chain. They may raise your prices. And if you're, depending on the strength of your business, you may or may not be able to raise your own prices. So that can impact your gross margin. And if your gross margin goes down over time, that's a display of general financial weakness. If your gross margin goes up over time, that's a display of financial strength. Remember that this is just one tiny little variable, one tiny little factor that goes into this mosaic that tells the story. So sales, cost of goods sold gives you gross profit, and then you count up all your operating expenses. After you total up your operating expenses and take that away from gross profit, now you have EBITDA, or earnings before interest, taxes, depreciation, and amortization. This is a really good proxy for cash flow in an organization. Because if you think of what that means, it's earnings of a business before you account for interest, before you account for taxes, depreciation, or amortization. And guess what? Those four categories depend very, very highly on how management has decided to finance this business. Let's say that you're somebody who has $5 million, and we had a client in the situation recently. They had a really great career at a big corporation. They were very respected. They worked overseas, great salesperson. They made a whole bunch of money. And then they retired and they wanted to go buy a business with the spoils of their efforts. And after a lot of discussions and a lot of due diligence and a few false starts, they were finally able to close on the purchase of a commercial cleaning business. But this person had some cash, and then they had to go borrow some money. And they're paying interest on that loan. And that's a pretty common thing to do. It's not bad. But for this person, their earnings that fall to the bottom line are going to be influenced by the interest on the debt that they're carrying. And that's different than somebody else who might have bought the business with all cash. They're not going to have any interest because they didn't borrow any to finance the purchase. And so earnings before interest, taxes, depreciation, and amortization is a pretty good way to level set the core operations of a business. And it's very, very common that when you're talking about cash flow, when you're talking about any kind of performance, you'll see gross profit, gross margin, and you'll see EBITDA and EBITDA margin. Because EBITDA is primarily what investors, what potential buyers, what sellers will use to value the business. And especially as soon as you get revenues over a couple $1 million, businesses are valued based on a multiple of cash flow, a multiple of that EBITDA. And the range, it could be between maybe 4 and 10 times the EBITDA that a business is kicking off. And so the changes in that margin, let's say your EBITDA ratio is 30%. So of the $100 that, or of the $200 that you're getting per computer that you're selling, $60 of it is available as free cash flow after you've already counted your cost of goods sold and all your operating expenses. And that's really the relevant metric that anybody considering buying the business is going to use, because they might have their own interest costs. They might not. They might be able to depreciate some of the assets or amortize them over time. They might not. And if you're merging with a bigger business, the tax situation might be completely different than what it is for this original business. So without going too far down the rabbit hole, when you evaluate sales, when you evaluate forward-looking projections and backward-looking performance, cost of goods sold, gross profit, EBITDA, and the margins for all of those are almost always going to be listed. And then you finally get down to the very bottom. So in EBITDA, we've already taken out operating expenses and cost of goods sold. Then we take out interest. We take out taxes that the corporation might have had to pay, depreciation or amortization of assets that gets taken out. And after all those expenses are added, then you finally have net profit at the very bottom of your income statement. And the net profit, this is what, when you hear earnings per share, this is what they're talking about. If you have, and I'm looking at this report right now on my other screen, the diluted earnings per share was 76 cents per share, down 53%, compared with $1.62 adjusted earnings per share. down 42%. So these earnings per share are, in this specific circumstance, are down by quite a bit. I'm not going to bore everybody by reading through this financial document and reporting back on why that's the case. But again, I can guarantee you that management is going to include some reasonable explanation, maybe even an excuse for why that's the case. And there may be a legitimate reason for that, right? But they're trying to explain away so that the future value of the stock is maximized. So earnings per share is what's left over. When you're going about valuing a business and determining whether it's in good shape or not, or determining whether you want to buy some or not, it's helpful to look at the margins relative to industry averages. It's helpful to look at the margins over time. And it's important to remember that the further down the income statement you go, the more opportunity there is for shenanigans and management to embellish the story that they're telling on these reports. If you're looking at just sales, sales are cut and dry. We sold $100 million of ice cream cones. There's not a whole lot of latitude for somebody to fudge those numbers. But if we go down further and further on the income statement, now we're talking about cost of goods sold too. And we're talking about interest expense, or we're talking about our operating expenses. The more line items there are, there's more, the more opportunity there is for management to tell the story in a way that's beneficial to them and further from the truth that you might be seeking to understand. And that's definitely not me accusing this Vista outdoor company of doing anything unscrupulous. I have absolutely no idea. And to be honest, I haven't even read the full report. But this is a thing. We have corporate fraud. We have a history of this happening, unfortunately. And there is more opportunity the more line items there are, and the more room there is for management to hide numbers and fudge them a little bit. So in the same vein, earnings per share is helpful, but it's not always the most descriptive metric that we might want to look at. It's helpful to look at, we talked about PE ratio. You may have heard about that. If you're evaluating a stock or the S&P 500 or a group of stocks, any group of stocks, you can compare the price at which the company trades to the earnings that it produces. Price divided by earnings. A lot of analysts, a lot of investors, a lot of portfolio managers like to use price to book, the book value of equity, or price to sales for that exact same reason. Price to sales is less influenceable by management and gives you a more accurate look at per dollar of sales, what does the stock cost? And understanding all these nuances is helpful when making your own investing decisions. Now, the other financial statement I mentioned that's important, but not quite as important, in my opinion, as the income statement is the balance sheet. The balance sheet is where you have assets and liabilities and owner's equity. The grand equation in accounting that always must be true, anybody who's taken any kind of accounting course will know this, assets minus liabilities equals owner's equity. And if you're taking an accounting exam and those numbers don't line up somehow, take another look at the question, because you're probably doing something wrong. That always, always, always has to be true. The bigger the balance sheet, the more equity there often is. This is a helpful financial statement to review to understand how levered a company is, how risky it is. It's important to understand what its debt service might look like. Healthier balance sheets will have larger assets and smaller liabilities and more owner's equity. If you have a situation where there's a whole lot of assets, but also a whole lot of liabilities, meaning that there's not very much equity, that means that the company might be a little bit riskier because its assets are being used to borrow money, and it is more highly leveraged. So from that perspective, ratios like debt coverage, current ratio, where you divide current assets by current liabilities, all these ratios kind of give you a sense of what the balance sheet looks like. So unlike an income statement, a balance sheet is a placeholder on one specific date. It could be a balance sheet as of today. It could be a balance sheet as of the end of the year, end of last year, whatever. But the income statement is over a period of time. We sold $100 million of ice cream cones last quarter. And on the last day of last quarter, this is what our balance sheet looked like. So when you're reviewing these things, always start with the income statement. Balance sheet is also very helpful, and both of them will tell a story. Now, we have a great capitalistic system that aligns shareholder interest with management and director interest. Remember that if you have a company and you decide to take it public, the people that buy the stock are usually going to have a vote when it comes time to make decisions. If you retain 51% or more of the equity and you sell 49% or less, then guess who's going to win the vote? It's you every single time. But if you only own 30% and other people, other shareholders, executives, partners, other random shareholders in the public markets own the other 70%, then you can lose votes. You don't have as much sway. And so it's the shareholders of the publicly traded corporation, that have the opportunity to elect the board of directors. The board of directors is the CEO's boss. The board of directors is the group that meets and makes sure that those executing the vision of the company are doing a decent job on a day-to-day basis. Shareholders elect the board of directors. The board of directors hires and monitors and then fires, if necessary, the CEO. And so there's this really strong system of checks and balances where if any one of them gets out of line, if somebody on the board continues hiring poor CEOs, guess what? Get a new board. If the CEO isn't doing a good job, the board's going to fire him and find somebody else. And up and down the line, for all three of those stakeholders, they all own stock in the company. They're all incentivized to maximize shareholder value over time. And that in and of itself is a fiduciary relationship, which just balances these issues quite well. So everybody in general wants the same thing, but the legal framework for providing these disclosures, while somewhat rigid, does have opportunity to tell the story in a way that management wants to. And there's a million reasons that management might want to embellish the current results and make them look better than they actually were, or maybe sandbag the results. Maybe they were pretty good, but they don't want the public to think so, and so they sandbag and wait to deliver really good news next time. And the other side of this is publicly traded corporations have to make forecasts of what they expect will happen in the future too, as part of that dialogue with analysts on all these earnings calls. And they don't want to disappoint the analysts. It's a game that constantly has to be played, and is also, by the way, the reason that a lot of corporations decide not to go public, because they want to develop the company's vision and mission and objectives over a longer period of time. They don't want to have to report back to the rest of the world every single quarter when the core mission of the company and primary objective is not going to be realized until a 3-year cycle has lapsed. Quarterly report cards along the way can just interfere with that. And so a lot of corporations will simply seek funding elsewhere so that they can avoid that whole problem. So those are a few thoughts. This really applies well to the review of any kind of business, whether you're an employee, whether you're an investor, big business, small business. publicly traded or not. I talked a fair bit in generalities today about how to go through this and cost of goods sold and all those things. A lot of the direct interpretation of this depends on industry too. I'm in the financial industry, and our income statements look a heck of a lot different than anybody in a manufacturing business. Because a manufacturing business has to have a much bigger balance sheet because they have to buy all these goods and equipment and everything to produce produce product. But us in the financial industry, it's more of a white collar human capital type thing where the main product is the skills and experience of the employees and the professionals. So they're apples and oranges. So just know that, if you're trying to review the financial statement of an outdoors company, and then you compare that with Chevron or Procter and Gamble or I don't know, KPMG or some service company, they're going to look very different, and it's hard to compare the investment merits of either side by side without taking a bigger look at the macro picture. All right, that's it for today. I hope this was halfway interesting. And again, if you have other mailbag ideas, email them to info@3oakswealth. That's all spelled out, THREEOAKS wealth.com, and be happy to include it in a future mailbag.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Be sure to subscribe to the podcast on iTunes, Google, Spotify, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements, and feel free to submit questions to growmoneybusiness.com.